Thank you for joining us today, our first webinar. This is our Multifamily Masters San Francisco chapter. I know that right now we are facing a lot of uncertainty in the market right now, and what better time than to keep educating ourselves and keep moving forward. So I really appreciate having Rob Chi on the panelist here, Feras Moussa on the panel, and also Kyle Mitchell. I'd like to have you guys introduce yourselves, and then I'm going to go through, Agnes and I are going to be moderators. We'll go through a few questions, and then we'll have a question and answer period. So that's how we're going to, how this webinar is going to flow. Okay. So I do have to make a disclaimer. What you learn here is not considered any legal or financial advice, so please consult your legal financial professionals for your specific situation. Okay. Again, intro, topics, and Q&A. And if you have any questions and answers, please put it into, type it out in the question and answer area, and Agnes and I will try to get ask the different operators their thoughts and to answer questions. Okay. So I'll let Agnes take it on from here.
Great, thank you. Welcome everyone, and thank you for joining us this evening. We're very excited to have an expert panel of multifamily owners and operators share how they're navigating their property through uncertain times. In a matter of weeks, more than 20 million people have lost their jobs, oil prices have collapsed, restaurants and airlines are cratering. So with all this going on, like, what is happening to the real estate market? Is it a good time to invest? We get asked these questions a lot. So we thought it would be beneficial to put together a panel to discuss these topics. So let's meet the panel. Could you introduce yourself and give us a summary of your portfolio, like what market you're invested in, and like the size and type of class type you're in? Ferris, you want to go first?
All right, I'll go first. Hey, everyone. Thank you, Agnes and Hedda, for having us. Definitely appreciate you guys going through the effort to put this together. For those that don't know me, my name is Feras Moussa. My partner, Ben, and I run a company called Disrupt Equity. And, we're at we've acquired 1,700 units throughout Texas and Georgia, are kind of our main two markets. We like Florida. That's definitely a place we're looking at as well. And, we're vertically integrated. We have management in-house as well. So definitely kind of on both sides of the business. And, it's been definitely been a busy couple of weeks. So happy to kind of talk through those as we progress.
Great. Rob, do you want to go next?
Sure. Hi, everybody. I'm Rob Chi. I'm a investor in the Bay Area, and been doing this for about 10 years. Basically, I have about 100 units, mostly in Redwood City, if you're familiar, which is in the peninsula, about 30, 40 minutes south of San Francisco. And then I do dabble a little bit in San Francisco as well, but primarily it's in Redwood City.
Great, thank you. Kyle.
Hey everyone, my name is Kyle Mitchell, and my company is Limitless Estates, although next week you'll see my company being APT Capital. Those of you that know me know I partner with Gary Lipsky, and we're actually merging companies to be APT Capital Group next week. So we own and operate 170 units out in Phoenix and Tucson. We have 2 properties out there. I've been investing in real estate since about 2010, started with single family homes, and now I'm in multifamily syndication. So we have 2 properties and we focus in the Tucson and Phoenix markets.
Great, thank you. We definitely have an experienced panel here, and I love that you're all in different markets, so we get different perspectives. So let's definitely let's talk about how the market is doing, and also how your portfolio is doing. How is rent collection, leasing activity? Are you having to offer incentives now? Who wants to take that first?
Happy to kick it off. I would say obviously monitoring that is critical, from the get-go. I mean, even before this month started, right? From last month, we put a lot of things in place from, putting prizes together, getting people that pay, on time. And then from that, really putting a plan together for how does our staff work with the tenants in terms of where they're at, what's going on, can we put them on a payment plan, do we need to help them find jobs, etc. So for us, we've been tracking collections and delinquency every single day. We have charts of it, And I mean, honestly, so far our efforts have been paying off. I mean, we have literally, when I was checking, one of our properties actually collected more this month than the same point in time last month. And most of our deals are all C plus, B minus assets, right? And so I think across the portfolio, we're kind of in that 90 to 99% of collections, right? With that one outlier that was at 101. So I'm actually, it's going a lot better than I was expecting so far, but I'm also much more curious to see what happens next month. Right, next month I think it's going to be the kicker, and so for us, we've really been trying to just get proactive and get ahead of it, right, and figure out, just kind of make sure we're still resilient.
Are you having to how's the prices? Like, are you having to offer incentives in terms
For
of
new leases or for current?
new leases?
So we're still leasing at the regular rate. It's kind of crazy. I mean, I didn't even think we'd lease much, but A, renewals have been easier, and B, we are still getting new leases at our current market rates. Right. So across the portfolio, we did decide to basically pause all non-essential CapEx, right? We've done a lot at the properties, right? So we are doing emergency requests only, right? And that's not so much to not spend the money on repairs, but more so our maintenance people aren't in people's units, getting kind of trying to reduce just proximity of staff and tenants, right? And that kind of, it's a win-win for both sides. But pausing, if we're doing interior upgrades, well, let's just turn those units, get them regular turns. Let's not do upgrades yet, right? Really putting a pause on things just to kind of build cash reserves, right? Alongside just what's our plan for the office? What's our plan whenever someone needs to tour a unit? Does a staff go with them? Do they not go with them, et cetera?
Yeah. Are you trying to renew leases earlier?
Yeah, so we are right where we can, and we have gave the staff discretion. Typically for us, if we're our leases on renewals, usually there's a rent increase, right? Especially kind of given where that lease was, and so we have told the staff that they can be a lot more flexible and kind of help get the deal done, right? So if you need to drop 20-25 from what we would traditionally do, then that's okay, right? So that's the threshold that we gave staff, but we have not had to do anything crazy, thankfully. So.
Great. It sounds like you have a great system going on.
It's definitely, I mean, yeah, we've been happy we brought management in-house. It's been definitely a blessing in disguise.
Great. How about you, Rob? How are your properties doing?
Yeah, so I'm seeing similar stuff to Ferris and also hearing the same things. April collections was about 90%. That's not including kind of people who kind of contacted us and wanted to do some payment plans. And with those payment plans in place, we're probably almost close to full collection, I think, with the exception of like 1 or 2 people. I think there's only 1 person who didn't contact us. There's this other weird thing where also both for myself and other people I've heard from, they've actually seen some people pay early because I think they were nervous about getting rents in. And like everybody else, I think we're all just waiting for May now to see how that looks. And it's also weird too, because there was an article going around where, they were talking about nationally, like rents were being collected about 30% under for April. But that is not what I'm hearing from other landlords or what I'm reading online or even my own experience.
Yeah, I was wondering about that article. Who's actually seeing that bad? So Rob, question for you. What kind of asset classes do you have?
I basically have A to C. Yeah, you could say the easier way to talk about my portfolio is about 40% of it is what you call tech, kind of white collar. And then the other 60% is probably B to C or blue collar, however you want to describe it.
And you self-manage all those properties, right?
Yeah, self-manage. I have a small team. I have an assistant who does most of the day-to-day property management. I have a couple of on-site managers as well. So we're pretty close knit. So I don't have a lot of like major systems in place, but yeah, definitely I've been reaching out and just telling everybody to keep their ear to the ground. We've been finding out what the situations are for each of our individual tenants and just responding on an individual basis. We did, I think some people are being more proactive about kind of reaching out, or I know there are some landlords who decided to cut rents proactively. I actually have not done that. Mine has been a more wait and see approach. And this may be largely a Bay Area thing, but I was prepared to do something a little bit more on the front end for our tenants. However, in the Bay Area, you just have a lot of like talk politically about how landlords, what's going to happen to landlords. There's a lot of legislation that's being thrown around that makes it a little bit more nerve-wracking as a landlord to decide to kind of proactively do things. So we decided for our operation to actually wait and see, and then just treat everybody on an individual basis where we can help out. And then also, I think the perspective has changed. Originally, I think people were looking at, maybe this would be a temporary 1 month thing or something like that. But, reality is this is going to be an issue, the non-payment, I think, at least till the end of summer around here. People having problems with it. And it's probably, my guess would be, it would go longer than that. So I'm kind of in the mode of defensive posture and help what we can, but also just make sure that we're capitalized the right way.
Yeah.
Your market scares me, Rob. I mean, it's definitely, I cheat and try to go to investor-friendly markets, but it's just kind of crazy some of the things that you hear of them thinking about doing, right? And as a landlord, it's like, how are you supposed to cope with that? So.
Well, from the inside, you're kind of used to it because we already have like rent control laws and stuff. And, yeah, some of the stuff that's being talked about does stretch the boundaries of where I think most people are comfortable. But at the same time, I think because people are so nervous and there's just a lot going on that I think a lot of the legislature is just throwing a lot of ideas out there that the reality is, I think some of it, like I know a lot of people are talking about this, I think it's AB 848 or something like that out here, which would actually force landlords to reduce their rents by 25% if their tenant can prove that they were affected by the virus, which is basically everybody. But I think that's more, I don't think that's likely to pass. I think most people don't think that's likely to pass just because most people think that that's probably an overreach and wouldn't be able to stick.
Yeah, I heard that too. It's pretty crazy. I wanted to ask you about you mentioned you have some like payment plans. Can you kind of talk about that? Like what kind of payment plans you've set up? Are they paying?
We've been flexible about it. So it's really, we're just encouraging people to let us know ahead of time. And pretty much the people who've reached out, we're just telling, why don't you tell us what you feel comfortable paying, do that. And then we will revisit, make sure that you're following whatever you set out for us. And then we're going to revisit once the shelter in place is done and people are getting back to work, and then we'll work out a more structured payment plan depending on where they're at that point.
Great. Kyle, can you share how your properties are doing?
Yeah, absolutely. So I invest in Class C properties, basically, and in the Tucson and Phoenix markets. And right now, as far as percentage of residents that have paid, we're at 86% on one property and 90% on another. The thing I want to mention, though, to make sure that everyone knows, is that percentage of collections and delinquency is completely different than one another. And so I would encourage people to peel back the onion a little bit deeper, because if you're just looking at collections, you could be missing something. And I'll give you a really good example. Our Tucson property, it's a smaller property, 42 units. It's 100% occupied right now. And if you look at the collections today compared to last month, we're at 108%. So we've collected more money than we did last month, and we'll actually collect more income for the whole month, right? But we have 4 people that haven't paid rent. So we're actually at 90% delinquency, or 10% delinquency, right? So these are 2 completely different numbers, because collections, depending on how you run your reports, includes other income, includes security deposits. It can include things like RUBS, a lease termination fee. So you got to make sure that, especially with multifamily, this is different for single family, but if you're running multifamily reports or relying on your third-party property management company, and I'm the only one here that has a third-party property management company, got to pay attention to that, because in one story, we're at 108%. And so if you said, okay, great, no worries, COVID-19 doesn't affect us. And then the other story is, hey, we have 4 residents, which is not bad, and we're working with them on getting paid. But on the other side of that is we're at 90%, right? And so you want to peel back the onion a little bit further than just saying, hey, what are my collections? Because it allows you to be more proactive. So now we're looking into May and saying, what are we going to do with May? And I actually think June is going to be worse than May. I don't know what your guys' feeling on the panel is, but people are not going to be going back to work until middle of May at best. they don't get paid for 2 weeks, and they have other bills stacked up. So, May will be an indicator, but June's going to be an even bigger indicator. And I agree with Rob. This is going to go through the summer, no doubt about it.
I completely agree. I think July is going to be, June and July are going to be the really interesting ones. And I guess just thinking about macroeconomics is kind of interesting, right? Because to me, the stimulus that was given isn't really that much for most people, right? Like, yes, that'll help them out for a month, maybe two, right? But it's not going to last much. And the government's kind of taken the PPP approach, right? Where, well, if we get the businesses to just pay the people, then they will have money that will indirectly help them to continue. So it's going to be interesting to see how they solve that. And once jobs start to come online, how do they solve it for the subset of the ones that aren't coming online yet, right? So those are the ones that are really going to, I think, hurt. So, which are
going to be the majority of jobs, right? Because even the people opening, half their jobs are not going to no longer be available. I mean, people are not going to open at full capacity. They're going to open at 20, 30, 40% capacity. So it'd be interesting to see.
Great tips. So I'm curious, how has your business changed since the crisis? Have you had to implement new systems? Feras mentioned stopping CapEx. How has your business changed since the crisis?
Yeah, for us, we have stopped all CapEx. Now the property in Tucson, we are through our value add, so we're a stabilized property there, and we're just focused on actually occupancy and increasing rent. So we listed that property for sale 2 months or 6 weeks ago. So that's definitely changed our business plan a bit. We're not heavily marketing it at this point because there's just not a lot of buyers out there. So right now we're focused on occupancy at that property. And then our other property was in the middle of a value add phase in Phoenix, and we have stopped all major renovations. We finished what we were currently doing, and now we're just trying to maintain occupancy and rent up. Leases have been surprisingly, they've gone down, but we're still leasing up, and we're leasing up at the full market rates that we originally had. So we haven't had to lower those either. So that's good news.
That's great.
And I'd say for us, I mean, two big things, right? In terms of acquisitions, right? That's definitely slowing. And we have had a couple brokers reach out this week with some deals that are blowing up, having issues where there might actually be some good opportunities. But I mean, just in general, there's to what Kyle said, a lot of sellers are waiting and kind of waiting to see. And then also on the acquisition side, the debt world has changed a lot, right? In terms of how much reserves we need to have, how much leverage they'll give, what are their, different escrow requirements. So there's a lot of fluidity there, and it's kind of hard to know how to go buy a deal if you don't know what debt you're going to get. But I mean, we're still looking, just not as actively, and kind of our threshold there just needs to be, a heavy discount, right? It's got to be more meat on the bone just to kind of give us more resiliency. And then on the operation side, we've been making lemonade from lemons, right? I mean, it's just kind of giving us a chance to pause things that we were far down the pipeline with and catch up on all the stuff that we know we've been wanting to do, right? Rolling out more processes, more systems, doing, different, marketing endeavors, all sorts of other stuff. So we've been really, really busy the past couple of weeks with those things. And it's been nice because we are getting to catch up on things that we've been just, the things that have been easy to push off, right? And so that's been a little bit of a blessing in disguise.
Great. Rob, how has your business changed?
So kind of the same thing. The major item is that I had a few remodels. I have a weld building that's been steadily going through a transformation process. And so I had to stop that immediately. And in fact, I probably stopped my work earlier than other people because I just realized that, all these people are no longer going to be at work anymore. They're going to be at home. So for me to be working on these apartment remodels probably wouldn't be a great thing. I'd be getting a lot of calls. So I actually stopped during the first shelter in place order out here, which is pretty early on.
Yeah,
whereas most other construction going on was not stopping at all around here. But other than that, it's been kind of business as usual. Speaking to what Feras said about the debt, I was actually on a phone call, conference call earlier today with, it was set up by Chase with Al Brooks. He's the head of their commercial real estate. And, he was just giving a general update, but he was saying, at least from Chase's perspective, is that, they're really just pricing in risk right now. So the same thing happened where I got lucky. I was doing some refinancing at the beginning of this, but right at the beginning of April, they basically just jacked up all their rates. And he said they're hoping that it would be a temporary thing, maybe about 60 days or so, 90 days until they can see what's going on. But the real trigger for them to be able to kind of lower things down and get back to normal is to see people going back to work.
Yeah, so on that financing questions, like I know Fannie and Freddie are requiring more reserves now, and you know, you probably have to factor in more economic vacancy in your underwriting. How has that affected your investment strategies?
Yeah, for us, it just changes the underwriting, right? The numbers still need to be the numbers at the end of the day. They have to make sense and they have to be what our investors are looking for. And now there has to be an added layer of caution for people to feel safe with it. So, you know, I'm certainly seeing more underwriting for us anyways in year one of a negative trend in rent. I do think rents are going to eventually come down because it's going to be a game of controlling occupancy. And then slow growth from there, hopefully in 18 to 24 months. But it really depends on how the next 3 to 4 months go. Like Feras said, kind of with the debt, there's a lot of unknowns right now. So we're still looking at deals. We're still underwriting deals, but it's going to have to be well below market to make us feel like we can go in and put an offer in on it. And the other thing that's changing that is, I guess, a good thing, it's definitely a buyer's market in the sense of terms and conditions for the LOI and the PSA going forward. You're not going to see a lot of hard money day one. You know, we're putting in financing contingencies for sure, longer closes, longer due diligence. Now, Arizona is a little bit more flexible. So actually our property management company just finished the due diligence yesterday and walked 92% of the units in Tucson, which is surprising. Our Arizona property, we are showing in person, but we're not walking with them. So we'll give 15-minute windows. We'll unlock the door. They can walk through during those 15 minutes and come out. So Arizona hasn't been as impacted from a stay-at-home perspective as much, but jobs are being lost and things like that. So I just think underwriting right now is a gamble or, you know, kind of a tough thing to do right now. So you just need to be extremely conservative. So it's definitely changed our game plan quite a bit.
And I agree with Kyle. I mean, it's fundamentally just the underwriting changes, right? And you're having to add in more buffer because you just don't know what kind of debt you're going to get. And I guess for those interested, I literally got a term sheet on a deal that it's a deal that we knew about 3 months ago. They were kind of shopping out for $95 a door. Well, now there's an opportunity to pick it up for like $76 a door, which is a huge discount for $77 a door, somewhere in that range. And it's a nice asset. So, I mean, we are looking at that more closely. And kind of the likely case that I have right in front of me is kind of DSCR about 1.35x, right? So for those that don't know, debt service coverage ratio, that's what that stands for, right? It's how much essentially buffer there needs to be between what your debt service is versus what they think the NOI will be on the deal. 2 years, 1 to 2 years interest only, which is down from probably being, maybe 3. And then the interest rate is about 3.5%. So it's actually better than I was expecting on the interest rate. And then the best case he gave me is the 3.25, right? And that's about 75% leverage. And so that's kind of what we're seeing now. And the other point that he made was that they did recently adjust their required reserves from 18 months to 12. So it's gotten better, right? More on the buyer set, more buyer friendly, but it's not as nice or as relaxed as it was before.
What market is that property in?
It's an Atlanta one.
Wow. We love Atlanta.
So, we're definitely shoring up all of our broker relationships, right? I mean, I am talking to these guys and have a missed call from one just a little bit ago and just really, kind of keeping a pulse and sharing data. That's the other thing too. Share data with your brokers, right? They appreciate whenever you share data with them and then they go tell people about it. It helps them. You're adding value to them, right? And then hopefully we're the first ones they think of whenever they're ready for the next deal.
Right. Awesome. So I want to see, let's take out your crystal balls. What opportunities and challenges do you see ahead?
I think the summer's going to suck. So that's kind of the elephant in the room. I would say, I think actually, so all of us are in multifamily. I think multifamily is actually cap rates are going to get better because people were, you were starting to see beforehand the pad site with the Chili's sitting on it was essentially selling at a better cap rate than what an apartment would sell for. Well, guess what? That Chili's doesn't have to be open, as we all learned, right? Now, obviously, this is a very rare event, but it still kind of reminds people, because people easily forget, that, hey, at the end of the day, people still need to live somewhere. The government is willing to help them make sure they have income to be able to pay rent, right? There's that safety factor versus Chili's can, I saw a thing where Cheesecake Factory just said, hey, I'm not going to pay rent to all of the locations, right? So as a landlord, it's like, oh crap. So, I think in the short term, cap rates across the board are going to go up, but I do think kind of where it settles, multifamily is going to come out strong, right? Just to kind of rehash all that for people.
But do you see some buying opportunities in 3 months or?
Fall. That's what we're shoring up and kind of preparing, or maybe now, maybe this deal works out, but probably fall is where I think you're going to start to see deals that were underwritten, too skinny, right? They were really betting on the big rent pops, the big, annual escalators, and they were, maybe in the midst of a big rehab. I think those deals are going to, and they're just weren't managed well, right? A rising tide, raises all ships. Right, you can start to see deals that just weren't being, deals that people just kind of gave to a management company and just kind of checked out. Right, you're going to start to see those deals probably come back to the market. And I'm already seeing one of them that I know. I've had 5 different brokers tell me about the same deal, and it's funny. I know the seller of that deal. That deal's having all sorts of issues right now, right? So those kind of things, situations.
Yeah, that's what I heard. Like, unless you must have something wrong with the property for you to sell right now. There must be something wrong. Yeah.
I think that's probably why it's good to keep your ear to the ground right now, just to see what is coming out. I'll be honest, I'm actually in wait and see mode though, so I'm not even really looking at too much stuff. In my market, it seems like sellers are still holding out on their prices for the most part.
They are
here.
It's kind of weird. Like some of them just think they're going to get their price. So.
Yeah, but I think that is true depending on what your all crystal ball says. If something does hit the market right now, chances are that person's probably hurting a little bit. So that could be an opportunity, but it's got to be measured against the risk of what you think is actually going to happen over this next rest of the year, I think. Yeah. But yeah, as far as opportunities, I think multifamily, at least in my market, is very much wait and see. I don't know if cap rates can go any lower out here, although that would be nice. I think everybody is looking for opportunity right now, especially people with an investor mindset. But I think they're going to have to be patient because everything is being pushed out by forbearance, for instance, and some of the stuff that the government's doing. So even people who are struggling can hold on for quite a while that stuff plays out, I think. But obviously, I know we're talking multifamily, but if you're looking at places that have gotten hit hard, it's hotels and commercial. So if you are looking at a place that got hurt real bad and you're willing to learn about it, then I think those 2 places would be the obvious ones to choose in real estate in general. But multifamily, I feel like for me, it's kind of hard to see what's going to happen. Yeah.
Yeah, for me, I think deals are still 3 to 6 months out, really. But the interesting thing is you see there's about between a 5 and 6% of loans are going to forbearance right now, which is a shocking number, being that it's only April and we've only been in this for a month. These are people that don't have the cash reserves, right? And so these numbers are only going to get worse because, like we already talked about, May, June, and July are going to be worse months. I can almost guarantee it. Yes, we have our stimulus checks. Yes, we have some better unemployment numbers, but those only go so far, especially in certain markets. And so I think anyone that's going for forbearance at this point is really in trouble. And forbearance, to me, it seems like a death trap. Everything I know about it, it does not seem like a good option. And really, the only way to take advantage of that is if you're in a very low cash position, right? Because if you're showing cash in the bank, the lender's not going to allow you to take the forbearance. So it'll be interesting to see. I do think there's going to be some opportunities for sure. There's bridge loans out there that are coming due this year that may not be able to get into agency debt. Maybe some IO is coming off, things like that. So there'll definitely be opportunities to buy. Like Ferris said, it's about building those relationships with brokers. We actually bought gift cards for all brokers and sent them to their houses as an anti-COVID care package to them, and just trying to get front of mind with them and talk to them every week. And, there may not be a deal today, but hopefully there will be in a couple months, and we'll be one of those guys on a short list.
That's a to network during this time. So that's a really good tip. Could you also let me know about forbearance? Because I've heard that unless you really have to, don't take forbearance. Can you kind of explain why it would be bad to take forbearance?
I'll tell you what I have read about it, and there's so many things changing every day, and the lenders are loosening up on some of these terms. But from what I know about forbearance is you have to be in a position where you really cannot pay your mortgage. You can't show $1 million in the bank and say you need help on forbearance, right? And then the other piece of that is what I'm hearing is you cannot evict a person for not paying rent until you're paid back in full. So you're almost kicking the can down the road, and you could really be putting yourself in a worse position, because if you take forbearance for 3 months, but it takes you another 3 months to pay it back, you're now in a position where for 6 months you cannot evict someone for not paying rent. So what is that going to look like for your property? So in my opinion, my advice to anyone is to try and do this without forbearance. I've talked to a lot of loan originators and lenders out there, and in the fine print or in the documents, it states this will not be a red flag on your on your cap. But from my personal conversations, it certainly will be. It will be taken a look at, and someone that doesn't have it will look better to Fannie and Freddie than to someone that does, certainly. So forbearance is only for those dire situations where that is literally your last resort.
Yeah, I definitely agree with Kyle on that as well. Don't do forbearance unless you have to, because there's strings attached. You don't really gain much from it. It's really, you got to be hurting to do it.
Yeah, and it's really the uncertainty. That's the biggest thing, right? It's that there's this unknown about paying it back versus not paying it back, and at what point can you evict and not evict. So it's that's the biggest concern. Just kind of there's a lot of misinformation out there, and that's part of the problem too. So
great, thanks for sharing. Yeah, great discussion. But so now I want to move to the Q&A, since we have questions here, and it's valuable to get your answers to these questions. So one question is, how do you know when to start CapEx investment back? Like what signs you have to see to start that back?
I can start with that one. And for me, it's going to depend. It really depends on every property where you're at. Let's just say you're in a situation where you've got 20% of your units vacant and people are not renting them up, then go ahead and do them. But the first thing that we're going to take a look at is, once we're through this in the next couple of months, does our business plan need to change, right, based on the current market conditions? We're doing in one of our properties, $13,000 to $15,000 renovations per unit, installing washer dryers. Is that the right move right now, depending on where the rents are going? So our business plan may change, and we may stop doing renovations altogether and completely change it. So, a business plan for a multifamily property is changing every week, every month, as you talk to your property management company and as you go through the process. And so I think it's something to be evaluated week by week, but your business plan can completely change from today to 3 months from now. So that's just my opinion on it.
Yeah. And I agree that I think whether or not you proceed with CapEx all depends on your numbers. So it will be good to revisit that. I can say for my particular strategy out here in the Bay Area, as soon as they let me, I'm going to get started again, because I just don't foresee holding off being an issue where my strategy is concerned. And I think this goes back to just the overall strategy for me is the same as it was previous to this. I kind of see this as more of a delay for my objectives.
yeah, and I'd say for us, I mean, it's about the numbers, right? Our units can lease without the CapEx too, right? It can be a non-upgraded unit versus an upgrade. So for us, keep everything fully leased, wait and see where things are at. Because the only reason to stop CapEx is about shoring up more cash, right? Have more cash reserves, because I'm not worried about next month. I'm worried, well, hey, if this drags out till December, right, and occupancy starts to drop, or people, collections start to drop, or do we have enough cash, right? How much, it's really about building up more reserves, right? And all of our deals, we have a reserves bucket. But now, you want to just keep more, right? Because there's no reason that we need to do the CapEx, right? It's not that critical. The deal still performs. It makes money. And so for us, it's about, kind of wait and see what happens with the macroeconomics, and couple that with, if things are going stable and maybe the economy is not recovered, right? We don't expect that to happen anytime soon. But if if we're stabilized, right, our occupancy is staying, consistent and nice, we'll start to do one or two units every, month or two, right? Are we still getting the rent pops? Because to Kyle's point, you have to continue to evaluate, because maybe you were spending $5,000 and you were getting $100 rent pop, right? But maybe now post-virus, people are, would rather not pay for that $100 premium, and they're just willing to take a standard unit to save that $100. Well, maybe you shouldn't be spending the $5, because now it's harder to lease. And now you're not collecting. Because in my mind, I'd rather have a unit that I can instantly lease rather than try to spend 2 months turning it and trying to lease it. Because guess what? I just lost that $100 profit that I'm trying to make just by waiting. So.
Okay, great, thank you. So we have a lot of questions coming in, so I'm just gonna go through them. Are you seeing or feeling a credit crunch access? Credit crunch, are you seeing that?
Credit crunch. There's a lending crunch. I mean, with all the kind of stuff we mentioned. I don't know. Do any of you guys have lines of credits that you guys use for anything particular?
I think they do mean lending, but we already touched on that. As far as credit, we had a HELOC and we took that out actually, because in 2008 they actually froze at all HELOCs. And so we actually pulled our HELOC out. We're paying interest on it right now, but it's at such a low rate, it's about 3%, that it's willing to take the risk on that for me to have cash available. I think cash is king right now, and we want to have some cash on hand to be able to buy.
I don't know if it would be a full-on crunch right now from my perspective. There's definitely, lending standards are tightening like we were talking about. But at the same time, I've heard some mixed stories just, in terms of even like single family homes. People are still able to find decent rates out there just by shopping around. Most of the big players though, they seem to be tightening up quite a bit, but there are brokers out there that seem to be able to still find options.
Great. Let's go through some of these questions. What's your opinion on DFW Metroplex market? I think Feras, you're closest. You're in San Antonio.
Yeah, so we're based in Houston. I mean, we like DFW, right? I think my opinion on DFW, I like the market from a macroeconomic perspective. My problem with DFW, and the reason we left even Houston, right? I mean, we bought in Atlanta. We started buying more in Atlanta because the pricing just didn't make sense, right? In DFW, its price is sky high. There's a lot of people that are overpaying that are, and my problem is that in the end of the day, the price that I buy at needs to feel right. So even if the deal makes sense at $150,000 a door, right? If it's a 50-year-old property, does that feel right if I could build it for close to that? I mean, and so my problem with DFW is price is really high. I mean, I think it's a great market. I think it's very resilient, right? They've done a lot of good things in terms of attracting jobs and stuff that Houston has done a very bad job at, actually, right? Houston knows that. I mean, I remember whenever Amazon was trying to figure out their next headquarters, right? I mean, Houston flat out said, we're not really structured correctly to help make a lucrative or something, an attractive offer. So DFW has done a good job attracting a lot of big companies that love that. I mean, it's a market that I like, the market I would buy in, but it's about getting the right prices. I think we're the fundamental issue. And I think, Kyle, I mean, you have a lot of the same things that you see in Phoenix, right? I know, the same problem that you're starting to see in Phoenix is happening there too, so.
Yeah, exactly. I mean, you can get priced out of a market. A market could be good from a fundamental standpoint, but you can certainly get priced out. And we've seen that in Phoenix, not so much Tucson, but I'm hoping that this downturn brings the prices down a bit and gives us another buying opportunity out there.
Great. So what cap rates have been recently, and should you expect them now to fall? But it's kind of different in every market, but I think we're all anticipating that cap rates will go up.
Yeah, I do anticipate the cap rates to go up slightly, and I do think that the days of offering memorandums being on pro forma rents, a year from now, I think those are slowly going to go away, and it'll slowly turn into a buyer's market.
Okay. So some cities announced eviction bans. How are you managing this?
Announce what kind of bans?
Eviction bans.
Oh, eviction. I think even the cities that didn't announce it, their courts are closed anyways, and so pretty much the whole country has stopped evictions. And I mean, it's just something. If you can't even evict the tenant, why would you not want to work with the tenant, right? That's kind of our philosophy, right? So figure out how do you structure win-wins is kind of what we've been looking at it.
Sure.
I was just going to say, I'm not so concerned with the eviction ban itself. I mean, I think out here it was established out of some fear that landlords were going to go nuts and like, start kicking people out. What I would say about the eviction ban is when you are getting tenants, keep to your standards. Don't lower your standards yet, because if you get the wrong tenant in there, you're not going to be able to get rid of them. So that's where I'm more concerned about, where the eviction ban comes into place, is who are the new tenants who are moving in. Yeah.
Okay. So what maintenance costs do you have every month? Do you expect to go up or down during this uncertain period?
That's a good question. We expect expenses to go up because all the tenants are living in their place the entire time. So more water, more everything. So that's something to keep in mind.
Yeah, I think utilities are definitely going to go up, water, sewer, trash, all that stuff. As far as our overall expenses, we're trying to cut them as much as possible. So only essential items are being purchased. Right now, we are not going into anyone's unit unless it's an emergency maintenance call. Otherwise, other maintenance calls are being not ignored, but set to the side for right now because we just want to minimize exposure. So our overall payroll or expenses will come down, but not too much. There's only so much you can do at the apartment buildings. You still want to be able to maintain them. If you're in a lease up mode or want to continue to lease up units, you've still got to have a efficient running business. And so we've cut some small things, but it's not like your expenses are going to be cut by 50%.
Question that I had for you guys too, of the properties that you own, what's the percentage that the tenants pay for their utilities and ones that you pay for the utilities?
So for me out here, the utilities reimbursement is fairly common. So for my apartments, it's about half. And of that half, we get reimbursed back about 80% of the utilities bill. So for that portion, utilities going up is not that big an issue so far. I mean, we could get pushback on it if people start using too much. But I know in other locations, utilities reimbursement isn't necessarily a thing.
Yeah, for us, our residents pay electric in both of our properties, so that's good. And then we pay water, sewer, trash, and we do charge back on the rubs. Although if there's an increase in usage in water, we're gonna see less of a percentage paid back because it's a flat fee for the rubs.
Yeah, no, and agreed. Likewise, I mean, for our deals, if they're not on rubs, we start to rub them back. So tenants pay most of it, right? And it's just kind of the norm in just the markets that we're in.
Great. So a question is, with possibility of a deep recession or even depression, where did it go? Or a depression coming, will you still look for more properties to buy?
Yeah, I mean, I would say at the right price, right? I mean, there's definitely a discount that we expect, right? We'll still buy the deals that are in the great areas, right? That are, better tenant mix, better location. But it's got to be heavily discounted, right? Because again, we're not buying for just a 1-year horizon. We're typically buying for 5 to 10-year horizons. So it's just gotta make sense, right? And we model it in. We know year 1, year 2, might not be great, right? Well, how does that work? How does that impact the deal? What are we doing? How do we show that we're resilient, right? We know occupancy is going to be lower, right? How do we, factor that in? So it's, in general, we have a good idea of what pricing should be pre-COVID. And we know post-COVID, we're expecting, good discounts to pick up those really nice properties.
And I think the true relevance, if we are in that situation, is to focus on your local market, because every market's going to be different. And whether or not you're going to participate sort of depends on those local factors and how you participate. I find that sort of the macro picture, it's fascinating to kind of think about and figure out what's going to be happening. But I think on a practical level, real estate is local to a certain degree. So I would encourage people to focus more on knowing their local market or wherever it is that they're investing.
Yeah, I agree.
So there's a two-part to this question. From a macro investment perspective, can you talk about how you evaluate investing stocks, bonds, Bitcoin, gold, silver, and multifamily. How do you allocate investment dollars?
Well, I'm a guy who's 95% in real estate, so I don't know if I can give advice on that.
Any questions? Agnes, that's for you. No. I think, yeah, I mean, I'm with Rob, right? I mean, I love real estate. There's a reason why I've shifted pretty much a good chunk of my investments towards real estate. At the end of the day, it's not tied to some CEO that can go do something fraudulent and then I lose all, it's a nice asset class. So I think that's very much a preference question for most people.
Yeah, and a knowledge question too.
I'm heavy on the real estate side and I still plan to be.
Yep, me as well. I'm heavy on the real estate side and have some pieces in some small businesses as well. But other than that, I like to have investments in things that I can control. And I think the other things on that list are very, very difficult to control, especially in an unknown environment right now. I think if you're trying to time the market on some of these things, you can really get hurt. So,
one other question that we have here too is like, when and why did you move from single family to multi-family? And well, a reason why.
For me, I feel like three reasons actually. It's tough to scale in single family. Single family is very singular, right? It's mainly based off of the house next door. If there's two houses that are identical, it's going to be the sales approach. In multifamily, you have more control. There's more creativity involved, and there's more of a management aspect. If you have two identical properties sitting next to one another, whichever one drives more NOI, whichever one is making more money, that one's going to be valued higher. So you have more control in that aspect. And so, those are a lot of the reasons. It doesn't mean you can't be successful in single family, but I think there's more flexibility, creativity in multifamily, and overall economies of scale as well.
Yeah, no, likewise. I mean, my first real estate purchase was a fourplex. Coincidentally, I'm at the office right now. It's literally a mile away from the office that I bought many years ago and got a taste for multifamily. Bought a bunch of houses from then. To Kyle's point, it doesn't scale very well, right? You end up having 12 loans, 12 insurance policies. Every loan is different. Every insurance policy is different. You have all the different tenants. I mean, it wasn't a scalable problem. So got into multifamily, learned about syndication, and just, it's a people's game, it's an operations game, it's a systems game, and all things that I really like. And so, kind of hopped in there, and I guess I've since found that really I can just leverage, because my background is software. I used to work at Microsoft. I came from that world. That, the opportunity really for me is about leveraging a lot of what I know from that world and apply it to, an industry that is a lot more old school, right? And kind of really be a little different. So.
And I'll say that I agree with a lot of those reasons for why multifamily versus other investment classes. But I will say that I fell into multifamily basically by accident, partially because of a timing issue out here. So I got into the market pretty much right after the Great Recession. And my first purchase was actually a duplex. And what I discovered is that the duplex market was recovering way slower than multifamily. And so I actually got out of that. And actually that first deal I did was ended up being pretty much break even. Had I held it for another 2 years, it would have done great. But in the meantime, I basically got out of it and jumped into multifamily because that area was already moving. The rents were already going up and there were already way more opportunities there.
Yeah, we're definitely all fans of multifamily. But I was curious, are you seeing more people demanding like bigger space now that everybody's working from home? Are you seeing like people want like an extra office or something? Are you seeing those leasing demands yet?
I think it's probably too soon to see that, for us at least.
Agreed.
Yeah, I had the thought that maybe that's the case, but I'm still waiting to see how the leasing does, because we're working on leasing out some new remodels with, a better place to live in. And especially out here in the Bay Area, if you're not in the A class, which is brand new and really, really expensive, then you're in some stuff that was probably built, well, if it's Redwood City, then it was built in the 60s or the 70s. If you're in San Francisco, it was probably built in like the early 1900s. So I wouldn't be surprised if that were the case, if this keeps going long enough out here, because there's just such a separation between the age of the properties and what you have to pay.
Right. Yeah, I'm curious to see that too. So another question is, are you lowering your credit approval standards for new tenants?
No, I think that's a bad move. I mean, doing that, it's just going to be a snowball effect. You've got to keep your standards in there. The only thing that I would suggest if you're struggling with that is up your marketing. Not only do we rely on our property management companies to do the marketing, but we help in that aspect as well. So don't lower your standards because you're gonna end up getting some bad tenants in there. And the thing is, right now you can't evict, right? So if you put someone in there and they just decide not to pay, you're in trouble. So you're just making the situation worse by doing that.
Yeah, you don't want to get to a race to the bottom. I mean, I'd rather drop my price and put in a better quality tenant than, kind of lower my standards, I guess.
Yeah, as long as it's economically feasible for you, you would rather have it vacant than have someone that you can't evict because they're causing trouble.
Okay. So hi, I'm looking for a duplex in Kansas City right now. Is there a good time to buy right now? What should I be concerned about? Tenants not able to pay, or should I just wait and hopefully price will go down?
Yeah, that's a hard one to answer. It's really a personal preference kind of thing. I mean, will prices go down? Probably, right? Across the board, whether you're duplexes, houses, or multifamily, right? I mean, we don't know. And so it's about, what's your strategy? So, and then again, also looking at Kansas City, right? I mean, again, real estate is localized and kind of being aware of that and planning for that.
Okay, so definitely more defensive and localized. Next question. Even without concerning COVID-19, are there regions that you recommend we avoid and why? Examples could be new statewide rent control measures in California and Oregon. So yeah, what regions would you recommend and what region would you recommend avoiding?
I think that's a tough question to answer. I think it's all about knowing your market. Rob mentioned it earlier, is know your market, be local to your market. You certainly don't want to be shopping different markets and going into markets that you don't know anything about. Real estate is even hyper local, not just local. It comes down to the neighborhood and the block that you're buying on. And so if you don't know your market, you can get into trouble really quickly. So COVID-19 is definitely going to affect other markets differently. Like New York right now is getting hit pretty hard, right? As opposed to a place like Arizona, not so much. But ultimately, it's too early as well to make those types of decisions because, again, 3 months from now, things are going to be a lot different in every market out there.
Yeah, and I would say, I mean, honestly, I'm more concerned about what's happening with oil than, in terms of regions than I am about direct impact from the virus, right? I mean, oil is an impact from the virus, but I mean, really, again, it's all localized and being aware of what's going on in your market, in your city. And to me, oil is the one that actually has an impact on entire cities, right? Whereas the virus is more, I mean, I guess they're both industry specific, right? But yeah, that's maybe my personal thought.
Right, definitely. I've heard lenders are stop lending to oil cities and tourism cities like Nevada. So definitely local. Let's see, what are some of the questions? What is your price per rental square feet in the market and the class properties you're in? Like, let's say it's a 1 bedroom and a 2 bedroom. What's the approximate price per square foot in the markets you're in?
It's $700 to $900 for us, depending on kind of different cities. 700 to 1,000 maybe is what I'll say for the the nicer 2 bedrooms. We do have one property where it's 1,200, right, 1,100, but it's kind of usually we're in that range.
Yeah, I mean, in Phoenix, depends on the area and the class of renovation. You can see anywhere from $1 per square foot all the way up to $1.75, $1.80 square foot. Our 2 bedrooms in Phoenix are going to go for $1,100 to $1,200, depending on the size and scope of renovation. And then in Tucson, we've got studios renting at $599, which is probably why our collections there are better because 1 week of unemployment check covers the entire month. So we're hopeful that property does better in May actually than the Phoenix property.
Yeah, and if you're looking in my areas, you know, $3 to $5 a square foot, and then you know, Class A is way higher than that.
Great. I think we've answered most of these questions. Can each speaker share how they first learned about multifamily and your journey and your lessons, 3 biggest lessons learned?
I'll go first. For me, you know, I was in Seattle. You know, like I said, I worked at Microsoft. I knew I was moving back to Texas. I just kind of accidentally fell into real estate in terms I just knew I wanted to diversify, invest in real estate, and kind of started educating myself and went out and bought my first property. 3 biggest lessons. Biggest lessons. I mean, structuring is important, right? Tenant quality is important. And then by structure, I mean, how do you structure the debt? How do you structure the LC? All of those aspects, right? Really, the debt is the big one, right? Because that can really change the deal and being smarter and looking forward. And then maybe the second one is actually the lender makes a big difference in servicing. That's the one that people don't realize till later, right? Having the right I will pay a premium for for a better servicer than I will for just any lender, right? And then the third one, I forgot what the third one is. I said it a second ago, but yeah, those are maybe my top 3.
I don't know if they're my 3 biggest lessons, but you know, there are things that I can look back on, and I don't think I made certain decisions outside of just the market being where it was, or just kind of randomly. But as an individual operator and a non-syndicator, I would say, looking back, the fact that I grew organically from small number of units to a larger number of units actually helped quite a bit. I was never undercapitalized, and my previous investments through this last 10 years were able to essentially fund my CapEx for the bigger apartments that I got into. I think in the Bay Area, I do think that it's good to have more consideration over whether or not to do the 1031 exchange or to trade up, because there is a big value in Prop 13 out here that, while I think I knew that it was a benefit, it wasn't until I traded out of a medium-sized apartment complex, where while I would say it set me back a little, because losing that sort of Prop 13, and that's having lower property taxes for those of you who aren't familiar out here, where it limits the amount that your property taxes can go up every year in California. Losing that basis and then going into kind of a more unknown environment with a new investment can set you back in a timeline if you have a plan in place. And so kind of taking better calculation of some of that, which is unique to California, is a big deal. And then thirdly, it's not so much a lesson that I've learned, but I would just say that right now, from everybody I've talked to who've been through multiple recessions, there's really not a lot that you can predict through these at this point. And I think that it's to listen and talk to a lot of different people, but form your own opinion at the end, because at the end of the day, everybody's crystal ball is really just an opinion right now. And so I think it's up to each individual to kind of listen to different folks, whether they're famous or not famous, or whoever you're listening to online or getting advice from. I don't think anybody knows exactly what's going to happen. So I think it's important to form your own opinion on that.
Yeah, for me, I found multifamily by pure luck. I mean, been investing in single family, and I just started searching on the internet for some things because I was looking for a career change, and happened to stumble upon Michael Blanc's class, took it, and just fell in love with it. My background is in property management, but for golf courses. So I understood the business model of it, and I love the business aspect of it, and I just fell in love with it. So that's how I got into it. Biggest lessons slash advice I would tell you is, number one, always stick to your criteria, right? Don't make a deal work. Stick to your criteria. And I think a lot of people over the next 12 months are going to be regretting that they didn't stick to their criteria. I think it's extremely important. And these types of things are a great example as to why you should stick to your criteria. I would suggest one of the things I did learn is make sure you build your team in advance. You know, on the deal that we first closed, we didn't have our team lined up. We were doing it as we were closing. And in a syndication, things happen very quickly. In a 3-week time frame, I mean, you're dealing with a PPM, you know, multiple lawyers, getting the PSA set up, raising money, all sorts of things. And so if you don't have your team set up in advance, it's hectic. And we definitely learned from that. And then I'll piggyback off what Feras said. It's extremely important to understand the lending side of things. There's so many moving pieces, so many things that can change. You have very limited control in most parts of that. And so to have the right partnerships lined up with lenders and originators is extremely important.
Okay, great. Thanks. There's still a lot of questions, but I think we'll take one last one and then we'll take the other questions offline. What is the break-even economic vacancy that you typically underwrite to?
I guess I'll go ahead and answer. I'd say it's really deal specific, right? Typically, you know, high 60s, low 70s. It's very deal specific. Do we like that market, that sub-market? Do we want to go less leverage or not, right? We've done deals where we did buy it at 65% leverage to just reduce risk out of it. That deal, and I could not do anything for like a year on that deal. It would still pay its note, right? That's awesome. And so it's really, you know, deal specific, I'd say.
So that's the break-even economic vacancy, 65% for some of your deals.
I don't think I've really looked at my deals from that standpoint. I think it works out to something like around, you know, 25%, 30%, somewhere in that range, but of vacancy. Usually the standards are based on other equations, and it does work out to a certain economic vacancy, but I'm usually looking more at the return and cash on cash and that kind of stuff.
Yeah, for us, it's 60 to 70%, but it absolutely is deal specific and business plan specific. You know, if you're doing a heavy value add, you definitely want that to be much lower than if it's a simple, you know, maybe it's just controlling the expenses. And it's risk versus reward for sure. And how much risk this deal takes on, you're going to want a lower break-even economic occupancy, meaning, you know, closer to probably 55, 60% rather than 70%.
And also, I'll mention too that it's a bit of a moving target as well, because depending on your strategy, you could come in and if you're doing a value add, for instance, then it could be a very different picture down the road as well.
Great. I think, yeah, so we'll take the rest of the questions offline. This has been really valuable information for all of us. So thank you all for participating.
Oh,
Thank you for all your time.
I appreciate it.
Yeah, thanks for putting it together.
Yep, definitely.
Yeah,
Thanks for having us on.
And if there are any questions that you guys have for anyone in the group, I'm going to share another screen. Please feel free to contact us, Agnes Wong, Agnes at Sparkpath Investments, and myself, head at Sparkpath Investments. So feel free to call us, okay? We're hoping to host another webinar in a few weeks, so stay tuned, and thank you everyone for joining us today. Okay, just make sure you keep washing your hands, guys.
Thank you.
Thank you, guys.